All right. So, good afternoon, everyone. A very warm welcome to all of you who have joined for this webinar, which is Electric Vehicle Fleet Business in India, Post Subsidy Outlook. Uh, my name is Rahul Maiti, and I'm consultant at JMK Research in the electric vehicles domain. And we have two panelists with us in the webinar, Mr. Maxson Lewis and Vani Mehra from Euler Motors. So I'll quickly tell about what JMK Research is. So JMK Research is a clean tech research and advisory firm, and we mainly focus into renewable energy, electric mobility, energy storage, and green hydrogen domains across India and Asia Pacific region. So this webinar, the reason we are having this is mainly that we all are seeing that electric three-wheeler adoption is actually rising in the last few years, and also slowly and steadily the electric four-wheeler, specifically the light commercial vehicle segment, is also gradually growing in that particular segment. And we'll try to cover these two things to look how these two categories and segments are doing without the subsidies. As we all know that in the L5 category, the electric three-wheeler, the subsidy targets have been achieved. So what we'll be discussing again, just to give in depth the business viability of electric three-wheeler and four-wheeler fleets in the post PMA drive subsidy is what I've said. Evolving the financial models, including the leasing and the battery as a service options for the fleet operators, how that segment works for the fleet operators, and the market outlook for the electric three-wheeler and four-wheelers. Then the role of the central and the Delhi policy, how that is going to impact this particular segment. And also we'll see what is the future growth opportunities for the fleet operators and OEMs, and also in the financing firms. So let's welcome our first panelist, Mr. Maxson Lewis, who is from Magenta Mobility, the founder and chairman. He has founded Magenta Mobility in 2018, and also he is someone who has really rich experience in building and scaling the EV fleet operations in India, and also someone who is actually at the forefront of deploying electric vehicle fleets across the last mile logistics business. Uh, Thank you, Maxon, actually, for giving your time and being present for this webinar.
No, thanks for welcoming. Thank you.
Next, we have the second panelist is Vani Mehra from Euler Motors. She is the vice president in sales and mobility at Euler, and she also has been part of the Euler since the Euler was founded in 2018, and someone who is having strong experience in the commercial EV segment, particularly in the electric cargo segment, to be fair, and also someone who is actually driving the adoption of electric light commercial vehicles among the fleet operators. So welcome, Avani, and also thank you for being part of this webinar and giving your important time.
Thanks for having me.
So before we deep dive into the discussions on this particular webinar, I'll just try to give a small context of the market overview. So let's see how the electric three-wheeler performance has been since FY 2019. So as you can see that this is the only segment in EV which has the highest adoption rate, that is close to around 59% as of financial year 2026. And also around 90% is actually dominated by the passenger segment in electric three-wheelers. And also, if you see, the adoption actually escalated since the FAME2 scheme was launched in the later 2019. Then we look onto the electric four-wheeler light commercial segment specifically and its performance since FY 2019. And as we see over here that the sales actually remained extremely low during the FAME2 scheme period between the 2020 to 2024 financial year. And there has been a sudden spike in this particular segment of LCVs adoption, even though this segment is not covered in PMA drive scheme, and that you can see it has happened actually after the FY 2024. Then we'll see that also it has actually achieved a highest ever sales with around 164% of year-on-year growth. And this is something that we'll be discussing more in the particular webinar and also get more insights from our panelists. Then we'll like deep closer into what has happened in the electric three-wheeler L5, and we know that in the PME drive scheme, the L5 segment has actually achieved the targets well before the deadline of March 2026. And this is the only segment which has actually achieved the targets well before the deadline. And again, pointing out that electric four-wheeler and also the light commercial vehicle segment is not actually included in the PMA drive segment. And still, we have seen in the previous slide that how that segment has done good even without the subsidies. Then we'll just have a overall overview of the L5 segment again. That when the FAME 2 ended, actually, uh, then we had the EMPS scheme, and then since the PMA drive scheme came into the picture, the L5 segment actually did really, really good. And then we see one particular point where it has actually achieved the targets. And since then, there is no subsidy. Still, we see that the segment is actually doing really great. And there has been no fall down for this particular L5 segment of electric three-wheelers. Last, just to let you know that we have actually released a white paper where we actually focused into the B2B adoption of electric three-wheeler cargo segment, and also understanding that why the electric three-wheeler cargo is preferred in the B2B fleet. And so the link will be shared in the uh, chat, and you'll get to know that you can access the particular webinar, sorry, the white paper. Then we'll, last thing, just have an overview of how the financial structure of electric three-wheeler goods fleet business work. Most of the time, we have seen that there are two very commonly known financial models. One is the asset owned, and another is the asset light model. In the asset light model, also, now we get to know that there are various other ways of asset light models in the financial options. So we'll discuss on this particular aspect as well, that how this thing works and what is more preferred in today's time. So now we'll start with the discussions, and I'll first maybe try to ask this to Maxson. This is for you. So we all have seen that in the electric three-wheeler segment, which we have recently discussed in the presentation as well, that the subsidy has actually ended. And even in the electric four-wheeler, the subsidy was not there in PMA drive. And still we see the highest ever sales happening in the LCV segment. So how do you look into this, and what do you think the uh, future of this particular segment will be if we take both in the comparison?
Sure. So first of all, good afternoon, everyone, and thank you so much, JMK, for having me on board over here. I'm joining such a webinar after a really long time, if a year, if not months. So I really appreciate you calling. And yes, the kind of experience that we have, and I'm going to share this both in terms of the three-wheeler space and four-wheeler space. And one of the first context is the three-wheeler space and four-wheeler space are different. While they're electric, the way they should be seen, understood, and adopted is also different. And let me explain these two. The growth of the four-wheeler electric is defined, and when I say four-wheeler electric, we're talking about the cargo, the LCV space. Was the bump up has been because there are more options available, right? So there, it was a case where the business was ready, there was a demand, latent demand, but the clients, customers like us wanted options, which started off, and since the options came in, you saw that 164% demand spike, irrespective of any subsidy or not. Second, also for electric vehicle fleet operators like us, the four-wheeler segment made a lot more sense because from a unit economics perspective, for the same amount of revenue per person or revenue per vehicle is higher in a four-wheeler than in a three-wheeler. And also more importantly, I think the entire industry was waiting for a four-wheeler. So even if unit economics did not work out well, the industry was waiting to adopt. So that's how the four-wheeler came. But the three-wheeler story is very interesting and very different. And it has taken the likes of 4 years and the likes of Euler, Magenta, and a lot of others to build that entire ecosystem. And today, what we did started off 4 or 5 years ago. Today, you can see the fruits bearing through, where the TCOs of electric three-wheelers have already fallen in place. And interesting, the adoption is not by fleet operators. The fleet operators took the original risk, initial risk, the OEMs took the. But today, the adoption of the electric three-wheelers is largely by people, individuals. We call them the driver come owners, etc. And Vani can talk about a lot more than I can do, but because she has an access to all of it. But from my individual view of how, so these two drivers are very different, and it is going to interestingly remain different till such time there's an intersection point. But at this point in time, that's my view of how the growth has happened, irrespective of subsidies. I think that's the more important point that I want to talk about. Yeah.
Great. Thanks, Maxson. Actually, that was a really good point to understand that the drivers have also been the adopters in this case, and also actually having a lot of options was one thing that needs to be looked after, because even I have seen this that the market was actually waiting for the four-wheelers, and three-wheeler was something that when we actually started with the EV adoption in India, three-wheeler was something was really easy to penetrate into the market. But actually, the market was looking for four-wheelers, and once we got to see that, we actually get to see a huge adoption in that segment as well. So that was really nice to know about this. So Vani, I have this question for you, and that is that from an OEM perspective, in your case, like how are you adapting the product offerings and the pricings in such scenario? Because when the subsidy is there, you definitely have to price your particular product and models in a separate, different way. And once it goes away, like in the case of L5, how do you position it into the market? And considering that you now also have the electric four-wheeler LCVs, and you also know that it wasn't there in the subsidy. So how do you deal with this thing from an OEM perspective?
So see, I think like any other industry, right? There's a subsidy era which creates an awareness, right? That will create the push, but the sustenance of it would come in the post-subsidy era, which will test the true discipline of that industry. And I see this as a triangle ecosystem, right? With charging infra, with financing, and with the OEM giving uptime. Any one of these breaks and the industry will fall. So when it comes to pricing, uh, you need for adoption to kind of kick in, you need parity in pricing with respect to ICE vehicles, right? Of course, TCO makes sense, but the upfront cost for which the owner would go for an EV cannot be double, right? It has, so typically how we see it at Euler is a 10% at max. That's when we can actually drive adoption. So the at max, someone would buy an EV if it is 10% more expensive than say a nice vehicle, right? That's when we feel that you can actually go and push the adoption because the TCO starts to make sense. They see the benefits within a foreseeable future. It's not that they have to wait for a significant amount of time before they start to see the benefits. Uh, so yes, I think that's on the pricing strategy part. And once you get scale, it's easier to, so like I said, the first part is the awareness part, right? At that time, we might not see scale, and that's when we also need support of subsidy. But as the volumes start to pick up and we get economies of scale, we are able to maintain that pricing even once the subsidy kind of goes away.
Great. In like with this, actually, I have a follow-up question that is based on TCO because this is something that both of you have actually mentioned, and we always get to listen this particular word whenever we are discussing about the fleet business. What I have known is that TCO is something which actually drives the fleet adoption, right? And that has been always the hot topic in this. So do you still feel that this is still going to be the main factor in the adoption in the coming few years as well? What is your perspective, both of you, in this particular TCO aspect?
I'll go first. If Vani, you want to go first
No, no,
on
go
this one?
ahead, go ahead.
Yeah. So, see, this is an interesting thing. And TCO, we by standard, the total cost of ownership, end of life, we calculate all of it. I think this is a very it's a layered answer. The way I look at TCO, and there are three, in fact, the way economists and financiers will look at TCO is different. The way I, as a uh, institutional buyer of vehicles, will look at it slightly different, and a driver owner would look at it differently, right? While the numbers remain the same, what element of that number is important becomes different. At the end of it, TCO mathematically is the same. The total cost of ownership towards an end of life, wherever you want to put it. For a financer, etc., one of the biggest angle to the TCO is the residual value of the vehicle, right? For me is the total end-to-end life and where I'm looking at it from initial purchase to the end of life and whatever is the asset cost, maintenance, all of it becomes so. I'm one of those guys as a fleet operator is one of the biggest one of the guys who's in balance between these two groups, right? But what about the driver? In fact, a person who intends to buy an individual owner, I think while he understands the TCO, his way of understanding is very different. Is first is like Vani rightly said, is how much I have to put upfront. मुझे सामने से कितना देना है? Because his ability that defines his risk. Because he's the moment he has to put money upfront, he's taking a risk on that money, right? And that determines his TCO. His so TCO by itself, if you were to give weighted average, I mean average weights to it, the weights are different for each. I would put it that way. For him, it is the most upfront cost. Second, for him, and the way they look at TCO is very interesting. Is if I've put money, how much am I earning per day or at the end of the month, and what mera kitna bachta hai? This is a very classic way of how he looks at it. So this is my understanding of TCO. The equation is the same, but the way we put weightages to each of it is slightly different. And how I think Vani, which is brilliant in this, as an OEM, when she speaks to a Magenta, and the way she will position a TCO for us, and she understands more brilliantly than anyone else, is different from the way she will position it and when she's pushing it to an individual owner. And the same thing when it's to finance, because one of the important components with Vani talked about a triangle is how the financer looks at it, right? And his angle is how long the vehicle can sustain, and hence it's important for him that the asset class becomes important. And whether the residual value he's putting it into the Excel sheet, how probable it is. So his weightages are out there. So this is my understanding, and each of us looking differently is best. And in many cases, at least in the EV three-wheeler space, all three are positive at this point in time. I like that fact, Vani, you said about a 10%. I also believe that for an individual owner, a 10% becomes I call it the hurdle rate, higher than this. In the case of an aggregator like me, the hurdle rate might be slightly higher, which could be 15%. I can take that risk because I have a lower risk, lower finance cost. So this is the angle layered answer to a TCO from my perspective. And over to you, Vani, on that.
Yeah, I think thanks, Max. You've already set the base. So see, even the retail customer, right? He might not be very tech savvy, but what he understands is dhanda. Like Max said, how much is he going to take back home that day, right? And see, for him, he's actually putting his family's certain savings, which would have taken them a good amount of time to put together towards this vehicle. So he will only take that decision if he sees benefit in it, right? And whatever it may be, TCO is something that customer will understand, and that is what will convert him. So TCO is going to play a very important role in the EV segment for the foreseeable future, because that upfront cost will always be there given the battery price, right? The asset is such. Uh, so it's going to be there. And on the fleet size, I believe that, it's not about buying the cheapest EV. It's
Yeah.
about buying the correct EV for the correct use case, the right payload, the right route, and sweating the asset. So whether it is the retail customer or a fleet owner, in principle, they are doing logistics, and that is what they are going to see.
Well, that was actually really nicely put by both of you on the TCO part. So, as we are now discussing about the cost part, I'll not like to take this discussion further in the financial structure part. So, I just wanted to know that this question is Maxon for you. That we have seen that there are various financial options for the fleet operators in this particular fleet business. I believe you started also with the asset owning thing, and then we have seen various different options where many fleet operators started thinking to make it asset light, right? And also various other options have actually come into the picture now, which may be something which you would know and I don't know in this particular segment, which I'd like to know. So, uh, would you like to put some light on this? That how is the scenario now after the subsidies have gone away for electric three-wheeler L5 category, and how these financial options are now going to come into the picture, and which do you think will be something being more adopted by the fleet operators? Maxon, you are on mute.
I've always said this, that any business, not only EV, any business, the most important vitamin is vitamin N. And when I say vitamin, the cost of that vitamin is the important piece, right? And the EV journey has been very interesting. Vani knows this. I mean, initially when we had to buy, the first time when we purchased an EV, there was no bank, not even a financial institution who wanted to risk it. So I have actually put my own equity money to buy it out, net straight up. Right? It's 100% payment made with some arrangement, etc. That was how it started. Then we had very interesting individuals and companies who came in with a fintech view of, well, listen, we are ready to take that risk. Right? Now compare this with the likes of Shriram Finance and others who has been doing financing for trucks for ages. Right? So now there was this intermediate which is called as fintech. Still, we did not have the traditional bankers coming in. After that, companies like government said, okay, let's do something. So SIDBI kind of tried to infuse it. Then a lot of lease-based structures came in, right? The same fintech organization started to go into lease opportunities. And interestingly, we were tracking our WACC, weighted average cost of capital, across all of this. Our original weighted average cost of capital was coming to at least 18% when we started off, right? Today we are at a point where, and just I'll give a Magenta view, where the original fleet, 10% of our fleet was, when we started, 100% of our fleet was bought out. From there, we started to pick up loan, much higher rate of interest, because the traditional bankers did not have these EVs empaneled in the ecosystem. So if you were to go and buy a car or anything, you just have to say, I'm buying a Hyundai, let's say a Santa or whatever vehicle. It has to be there empaneled in their ecosystem, and then the entire process falls through. EV was not even part of the ecosystem. So it has taken years of us showing that EVs is profitable and OEM. And I remember, Vani, you and I, how many finances we have had discussions together to prove that your vehicle is right and the user also is right. Fortunately, today what has happened is, today two things have happened. The average cost of capital has drastically fallen because, one, the supply of funds has started to come from the traditional banking or financial institutions, which means now, the typical commercial trucking business for an individual, let's say a truck owner, I'm just giving, if we were to buy it, it's close to around 13 to 14%. Even institutional buyer, let's say a large company has to buy it, it is come to around just around 10 to 11%. In the EV, you always had to pad up 3% more as financial costs, right? But the best part is, I think we kind of invested our money to build the ecosystem. OEMs have done it. Today, the cost of capital has reduced. And when you now look at it from a TCO perspective, And I like what Vani said. You should start a business to take. Your business should take advantage of subsidy, but your business should run irrespective of subsidy. Right. So today that has happened where because of this lowering cost of weighted average cost of capital, which for us today now is around 11.5, 12%, if I were to look at it, which means that I am now able to pick up EVs at the same financing cost as if I were to pick up an ICE truck. Right. And this has evolved. And somehow I have a feeling, and I don't know, and I wish comes true also. I believe that the EV financing cost should be much lesser. You know why? Because the amazing amount of data that comes to an EV, the financing institution has a lot more control over what is happening. He's able to see his vehicle live, which in a truck, he has to use a mobile phone of a driver who can walk away. So I would believe that the risk bias which was there towards EV by this financing institution should be actually negative as compared to it. And I'm hoping that will come. But at this point in time, it is what I said, right? The gap between the EV financing was around 2 plus 3+%. Now it's come to 1%, 0.5%. And I will be happy that it becomes 0-0. It means if I were to buy a truck, diesel truck or EV should be the same. But I'll be much happier when the data, the ability to use that data should help us reverse bias the finance cost. I would say that, and I always like to bet into the future. I would say we are at least a year or 2 years away when that transition will happen. And that time that nothing will be able to know, no one can stop the entire flooding of the EV adoption, especially in asset classes like the cargo vehicles. So this is my view of how the cost of financing is driving the adoption as well. And subsidy, like I said, it's a bonus. We don't even use that in our Excel sheets. We of course want to have it, but our business model should be dependent upon the utilization rates and how we get lower cost of finance than the subsidies. And subsidies also have a geographic, socio-economic, and socio-political aspect, which I don't want to run my business basis that. My models don't. So that's where I stop on the cost of finance.
So, Vani, I have a little different question for you in this aspect, and that is in the B2C sector, we are now seeing a lot of BaaS adoption options, right? And this is, we all know, to reduce the upfront costs. So, what I want to know that why do we see less of this BaaS option in the commercial segment, as you would be able to give a better insight on this, considering that Euler now has three-wheeler and four-wheeler both providing this to the B2B market.
Yeah, so see, I believe that logistics is an industry where we have predictability, whether it is route, kilometers. You know, when someone is buying a vehicle, he is pretty much aware what type of distance he is going to run. And hence, BaaS may not be the right product for such a predictable system. It works well in personal vehicles where you have variability, but for commercial vehicles, see, BaaS, it's a pricing innovation, but it's also a risk allocation issue over there, where someone is owning the battery performance risk. You need control over warranties, the degradation, and the data needs to be seamless between all the parties, right? So I feel it'll pick up in this space also, perhaps in the future, but we need certain more maturity for it to kind of become standardized in this particular industry. And just to add to what Max was saying on the financing piece, see, I think we've come a long way in the EV industry where now we can actually define our residual values. And when we started seeing change of hands and the financiers have started to believe in the residual value is higher than what they had thought it to be, the cost of financing has significantly improved. The risk-taking appetite has improved, and hence the rate of interest at which we were getting these loans has it's bridged between what an ICE and an EV was. But at the same time, I also do feel that like Max was mentioning about the data aspect of an EV, the financer who learns how to underwrite the battery risk and match it to the use case of the customer will actually own the next wave of EV financing. I think it's not just, ICE vehicles did not have this connectivity, but the way in which you can monitor the health of a complete electric vehicle, uh, you have much better control on it, and it should support the risk underwriting and risk appetite.
So, with this, is it safe to say that the lenders are now feeling confident to actually give good financing options for the EV assets?
We've come a very long way from where we were to where we were today. Established banks, everyone is doing it. And there was a time when people did not even want to touch EVs.
Yeah, long way is an understatement. I think you should, and people do not
Revolutionized
realize.
it.
Yeah, people do not really realize the kind of effort it has taken. I mean, Vani, I think the biggest sales pitch that you have to do was the financing institutions, right? To say that, yeah. So
Yeah,
it
we
was
had
not
customers. We needed how to get the money available.
correct. So, like I said, that business comes through money and the conversations. And I mean, Vani had to pitch that the asset that she's building, Euler is building, is of something which they can bank on. With us, they had to pitch that, hey, listen, this is something you can use. We had to pitch to the banker saying, if that asset is safe with us and we know how to use it, right? And this has taken, I would say, the last 4 years have been educating these financial institutions, literally
4 to 5
educating.
years, yeah.
Yeah,
It's been also building credibility, I would say.
yes.
Uh, uh, Not just for ourselves, but for the industry.
Yeah, I mean, time and like late Manmohan Singh ji all used to say, no, the future people will come to realize what is the kind of effort that has gone in. A lot more effort. I mean, what you see today as the adoption of EV has come on the back of a lot of effort, successes, and a lot of failures. And sometimes we don't talk about it as much. I mean, it has taken enough failures also for the bankers to realize that it is not the risk is not the battery or the EV, the risk is somewhere else, right? So that movement has actually helped. But today, I don't think the bankers talk about, hey, listen, what is this? The I mean, there's also, and I think I can speak this openly on a forum like this, where earlier there used to be like 10 or 20 or 30 so-called EV manufacturers. There was a lot of consolidation. So, and what that happened is the kind of low quality OEMs, if I were to say, or someone who did not take a long-term view on things, have kind of withered away. What we are left with is a set of OEMs who have put in a lot of time and bandwidth on the R&D, etc. And those people who build, I mean, those people who have withered away are also part of the ecosystem who kind of give data of what the banker should look and not look for, right? So, like I said, right, it is the effort, the successes, and also the failures of this ecosystem. And today, yes, I don't think the question is ever now going to be from a banker's perspective about, hey, listen, whether we should fund an EV. The question should be what is the lowest cost of risk they should assign. That's the conversation.
I think there used to be all random things in the early days, like, okay, we won't fund the battery. Okay, then in the EV, what are you funding if you're not funding the battery, right? I mean, that's the heart of the vehicle, which is going to make it run. I mean, there used to be battery theft. The L3 segment was a very unorganized segment, right? And with L5 also being a three-wheeler, it came with certain perception that this will just be another L3 plus plus. So even with insurance companies, okay, we won't give you insurance on the battery, but then that's like battery prices have come down now, but back in the day, it used to be over 40% of the vehicle cost. And if that is not insured, then the customer is not
What
going to be
else?
comfortable in spending that money.
It was like you are giving me everything in the vehicle except the engine. So chala hai. And trust me, very interesting conversations. Vani, I remember some of the conversations, so all layers, see, the ecosystem had insurers, financiers, asset operators, and all of that. Each of that required a convincing, and it required a couple of teams to come together and convince them. And I'm very happy, I remember the day on oil, we purchased the 504th Euler machine. We actually cut a cake together. And that was to tell not us, it was to tell the world that, hey, listen, this ecosystem has matured. It's time for them to also take that risk and kind of fund the growth. And I'm happy where we are today, both as individual companies that we are and also how the ecosystem is actually.
Yeah, been a collaborative effort for the whole ecosystem.
So, in this B2B fleet, what is the usual vehicle life or I'd say the resale market value now in this case? So, something that you'd like to say on this?
So in most cases, Vani and I have agreed, but in some cases we may disagree, and this will be one of those points.
Let's see.
Let's see.
You can go first, Max.
Okay, so here's the interesting part, and I remember, and no names here in terms of the brands, and certainly it is not Euler. Euler was one of the highest quality vehicles since day one. The Gen 1 vehicles that we purchased, we actually wrote off the entire set of vehicles within 2.5 years. We've written it off. I've written off this vehicle because, and we took this conscious call. I mean, I remember some of the board is that, hey, listen, we are doing this because the ecosystem has to grow and someone has to put that money in. So Gen 1 vehicles, 2.5 years. And we wrote it off. Then we had the Gen 2 vehicles. Today, Gen 3 and Gen 4. Today, I think we are in the, and funny, this is my version of the generations. Yours could be different, like they have in people as well. So I believe today we are at Gen 4. And today what is happening, the kind of warranties that the OEMs like Euler, etc., is extending to us is 5+ years, 5+2+2. And I mean, in the passenger segment, Mahindra is talking about the lifetime warranties. Now, how this has been possible is on the back of the data, the kind of tech enablement, and also the cost of batteries reducing. So there is a higher risk that we can take. Today, see, I don't think the issue is about the battery any further, the degradation in batteries, etc. I mean, you have fast charging, super fast charging, all of that. But very interestingly, in LCVs, we don't use fast charging as much. We use slow charging. So we have also understood how. So the question around, so the warranty today has moved from pure battery warranty conversation to overall vehicle warranty. And for us, one of the conversations about the spare parts. Ability for the OEMs to provide these spare parts. Unfortunately, for the OEMs, the sales happens across India, and the spares have to be moved. And any downtime for me as a company is I am not only, if let's say Rahul, you don't have a vehicle, a car, you can say, okay, I'll take an Uber and an Ola and use it, but you will still reach your destination. In my case, every downtime, every minute is loss of, it's an opportunity, a business loss. Right? So how I look at it as is, so it's warranty, and from the warranty conversation is now moved to spares availability, quality of service, which is an amazing maturity in the conversation. So I think that's where, and Vani, over to you if there's any difference of opinion.
Yeah, I think uptime is currency in logistics, right? So there's no differing over there. When you talk about residual value, Rahul, I would say that we've started to see a couple of hand changes, but not all that many, because probably the degradation which we were expecting in the fourth or fifth year, the batteries have performed better. They're still able to meet the intra-city logistic requirement, and hence customers are continuing to use it. So that will probably help push the residual value even higher.
Great. So we'll come to the subsidy topic again, and this is with reference to what Maxson said that in his calculations he doesn't consider subsidy now. However, he'd still be happy to have it if it's there. So I just wanted to understand first this thing from Maxson is that what are you looking into the policies in general for the fleet adoption? Do you still feel that it should be continued? Like I'll now talk about electric three-wheelers, considering that four-wheelers didn't had, and in the three-wheeler, the achievement has been already there from a target point of view. So what do you think? Are you still expecting anything from the policies?
Sure. I remember, this reminds me of an article I wrote in 2018 about the role of a subsidy. When an industry, it's a fledgling industry, I mean, that is the time the subsidy helps to kind of build the ecosystem, right? But if a subsidy stays too long, then it becomes a non-competitive. So whoever gets subsidy or who can chase for subsidy. So it's no longer business positive; it's business negative. So I'm always been a person, and this is where every ecosystem will have a subsidy and should move out of the subsidy zone as soon as possible, because then the business will operate on how pure business optimization, not subsidy optimization. But now coming to this in the EV space, I look at it even in three-wheelers, three-wheeler cargo, three-wheeler passenger, right? You take four-wheeler LCVs, you take four-wheeler passenger. And this is one of, I would say, I would put it as a grouse out there, is the policymakers have taken two issues with, and I'm being very upfront about this. Two issues is, one is a short-term view of how this subsidy will play out, right? Typically, subsidy angles, and so this is one view, is that their short-term view is taken on the back of abhi budget hai to uska kya karenge, right? Second, the way it has been deployed, it should have come from first principles is do they want EV adoption, or do they want EV adoption for a certain sector, right? Because the EV adoption was initially supposed to be driven by beating pollution, if I were to say, right? It's the greening of the ecosystem. If that was the case, it should have been where maximum, kilometers are run, and where there's a most positive impact, and that should have been in the cargo and the LCV segments, or commercial segment. Let me put it commercial segment, because different passenger commercial also, and that should have be the super focus, right? That would have, for this, every dollar or every rupee invested in subsidy would have come to a larger greening or faster greening in terms of number of kilometers on the. However, what I felt is at point in time by central or even by state, it was largely driven by a factor of what people or some bodies or some elements would want. Hence, I mean, think of it, a passenger segment was subsidized initially, which was not required at all, because they were not the primary buyers of the vehicle. It will always be the second or the third car. So I think so. These are my two grouses in the way the subsidies were handled. And this is important. This is money out there to build an ecosystem. For three-wheelers, it went to that fluctuations. Right? Sometimes it was there, sometimes it was not there. In some state it was there, some state it was not there. It made sense to buy in Delhi and then move that vehicle somewhere else. So those disparities, I would have expected it to be better, thought through a little bit more. On the four-wheeler at this point in time, and I'm talking about purely the LCV, those subsidies are, I don't think they qualify, and the way it is structured today, I don't think so. Which I thought was important right now. For a four-wheeler LCV, it would have made amazing sense to have a subsidy right now, because it's still what happened in three-wheelers 3 years ago. We are exactly in that phase right now. And today, if we were to do this, the adoption of that four-wheeler LCV would have taken off. And certainly it impacts me from a cost of it, but for the buyer, who's the retail buyer, the impact would have been much more. And trust me, the number of kilometers an electric LCV four-wheeler would have run as against a four-wheeler. There's a typical case point, a passenger vehicle is typically 50 kilometers in a day if he uses it every day to go to office, while a cargo would run at least 120 kilometers a day. So it's a 1:2 ratio anyway. So for that same 1 rupee subsidy, you could get a dual positive impact. So I felt that some of these things could have been a little bit better. Of course, there are a lot more sharper minds in the policymakers. They would have their own view, but I'm talking from a user's perspective. Oh, okay, yeah, that's my part.
Yeah, in just continuation to what Maxson said, that he would be happy to see some subsidies in the electric four-wheeler LCV segment. And this is what I actually wanted to ask Vani, is that whatever Maxson has said is that I absolutely agree, but we still see that the adoption in electric three-wheelers, specifically L5, has been very, very high in terms of the adoptions and during the PME drive scheme duration, right? And as a reason, we see that that was the only segment that achieved the targets quite early.
Yeah.
Do you think that it should be still continued? And another thing is about the four-wheeler part that he said that that is a segment that he wants to see. And considering that Euler now has four-wheelers in the portfolio, what would you like to say on this four-wheeler LCV part?
So obviously, I won't deny any subsidy which comes my way, right? Nevertheless, I think there are state subsidies which are supporting the N1 category. So Maharashtra is a good market for us, and we get as much as 1 lakh of subsidy. So that makes our vehicle even more competitive with respect to ICE. So, I mean, it's very easy to convince a customer there that this might be a couple of thousand rupees cheaper than your ICE vehicle. So state subsidies are, while of course central government subsidy is not there, state subsidies are there, and then the latest subsidy uh, under formation right now being the Delhi state subsidy. How I see the government now looking at this is moving more from an incentive driven subsidy to a mandate driven policy. So earlier they were allowing certain pilots and maybe fleet aggregators had certain percentages to comply with, and now it is like a compliance, like it's a rule which everyone will have to follow. So it's become mandatory. So I think that would help with the pollution aspect which Max was mentioning. But of course, I mean we need to also first see which category is creating the most pollution and then electrify that. But then also, I think if I talk as an OEM over there, the parity in pricing for that segment may still have a certain legwork to be done on. So, but yeah, having said that, I think we would welcome all subsidies on the N1. It's definitely where L5 segment was 3 years back. Um, it will definitely speed up the electrification if we get anything. And on the L5 part, which you were saying with the PME drive going away, I think the awareness has been done. We have enough units in operation to prove the business case for these vehicles, and now it will run on word of mouth. So that the L5 segment has become mature enough. You were showing numbers of 55 to 59% electrification, and we've crossed the 50% mark. So it's well electrified, and that growth will continue. We've The government has done its bit
So
over there.
yeah, so with the government mandate part that you said, I'll just like to spotlight about the draft Delhi EV policy,
Yeah.
right, that we have seen. And in that, we have seen that some sections have been excluded, and that is specifically the L5 cargo, right?
Cargo.
I know this is something that Maxson has a lot to talk about it, but first I'd like to ask you, Vani, that that particular draft policy has specifically included L5M and then
Yes.
the N1E electric four-wheeler, that is the LCV category. So, what would you like to say and talk about that particular draft Delhi EV policy?
So see, for me, L5 cargo for the EV industry, the L5 cargo is the baby of this industry, right? That's what started this whole industry. Uh, Whether it was pricing, whether it was use case, it was one part of the electrification which drove it. But how I would see it, Rahul, is that if you see the TIV of all these three segments, L5N, the three-wheeler cargo segment is roughly one. If I talk about ICE, it's about 1 lakh units pan India. Whereas if I was to talk about the N1 category or the L5M category, these are both 5x in size. So the impact which would come by giving subsidy on these two would be 5x of what it would be by giving impact over there. And we this is like already 50% plus electrified. So I would agree that okay, the budgets are being put where we would be able to multiply the impact.
So, Maxon, I think definitely you have a lot to say on this, as we know that
Yeah.
the L5N category is specifically being excluded in the Delhi EV policy. So, how do you look into this?
See, I think the L5 category has found its roots the things are in place. To a certain extent, if I speak from an OEM perspective, a lot of the production facilities have been well depreciated. Also, so those are also the books are looking healthier for the OEM for the L5. So to that extent, I do agree that it's a staggered view of kind of moving the L5 category down, and the this has been offset by the cost of finance, reducing cost of finance, right? It's a net off for a buyer is the same, to be honest. What I and my reference is the fact that the larger LCV segment, which is now the growth segment, and this is a very interesting fact, and of course, Vani would know it, is the largest component of transport of goods in terms of volume base is on the four-wheeler, the LCV category, right? Because that's where the actually the intra-city what do you say logistics happens on the highways, and from a bulk perspective, an LCV carries more than what a three-wheeler carries. So on a subsidy per tonnage perspective, I think it's a plot which has been missed. I wish it was thought of it that way, in terms of kilometers, in terms of tonnages. And yes, like I said, of course, like Vani brilliantly put it, we don't build a business on the way, but if any money coming in, it helps. And I'm not talking from a Magenta perspective, and I want to be upfront about this. We will still continue to do business. Our purchases are in the four-wheeler space. Our largest purchase is now in the four-wheeler space. And we are doing brilliant business. But I'm talking from an ecosystem perspective. Like I said, right, the elder kid has already gone. Three-wheeler incidentally, the elder kid has gone to college. School का tuitions भरने वाला का बच्चे का भी manage करना चाहिए था, where it is missing right now. And this kid has a lot more capability to decarbonize. So I think it's a missed opportunity. I would openly and upfront say that. So I cry less for the L5, but more for an LCV subsidy lost if I were to do it. And I hope, Ani, that's what you're not also saying the same thing.
Uh, I think on the L5 front, there's still in the Delhi draft, there's still some relief on the registration part, etc., which is also 20,000, 25,000. So it's okay. With the L5 going away, I'm okay with it. I think that will continue. But yeah, I think on the LCV segment, like, where are the fumes coming from if we're talking about pollution?
Yeah.
So, Maxson, in this regard, what I wanted to know is that how do you see the future of this B2B fleet segment in the next 3 years, right? Because what I have personally seen is that I have actually been to the Magenta areas where there are vehicles, and at that time I've seen there were a lot of three-wheelers, and also the one that you are saying have phased out. I somewhere know that which one have been phased out, right? So, and then I have also seen the stage. This was back in around 2 to 3 years back, where slowly I have seen you adopting to the four-wheelers, right? And now, as we have actually said that the business is actually shifting more towards the four-wheelers, and this is not only with you, with other fleet operators as well. So, how do you look this business in the next 3 to 5 years? And is it like we will see less of electric three-wheelers and more of four-wheelers? Because I think three-wheelers is required considering the lanes of India and the maneuverability of it, right? So, what would like to say on this?
So you are asking a business strategy, future business strategy question, but I'll answer. And in all honesty, this is upfront and straight, and you know that I will always answer straight up. So, see, the reason to go three-wheelers was because the product availability in the three-wheelers was there, right? But let me talk not about Magenta. A fleet operator, a classical fleet operator who is operating assets, his biggest fleet, as against a single retailer, his biggest cost, other than the cost of this, is the corporate cost. Now, where can I defray the corporate cost maximum is by larger formats. So logically and by the technically, fleet operators would always prefer to have larger format vehicles because less number of people to manage a higher tonnage and higher revenue. And that directly defines my corporate cost. and my gross margins really speak. So very simply, it made sense for Magenta to move towards the four-wheelers, right? But that doesn't mean that the three-wheelers purchases have reduced. Now, what has happened is the adoption of that same three-wheeler. Earlier, Magenta did the job of kind of building confidence, building the ecosystem with OEMs like Euler, proving to the customers like the e-commerce and others that, hey, this works, right? We have moved on to a larger format. We have not given away three-wheeler. We have moved on to adopting larger formats. But the same three-wheelers are now being adopted by these drivers and retailers in a much number. Earlier, they had to take a risk, which we took. Now we have. So in our case, our focus, our new purchases are heavily towards the four-wheelers, right? And I want to be upfront about it. We are still operating the three-wheelers. We'll continue to operate the three-wheelers. And like you said, there will be by-lanes in which the three-wheeler only ja sakta hai. I mean, there cannot be a four-wheeler. But if you look at it from a focus, our focus will be four-wheelers. Three-wheelers will be on an opportunity basis, right? And this is not only true for Magenta. I would believe that any fleet operator in the EV space would also go classically that way. Unless and until by design, it's a, hey, listen, I only want to operate, and he will go all in on that. But there, the way he deploys the vehicles will be in a very different model, not the typical large institutional operator. So that's my answer, and I'm very upfront. As a company, our business plans are more skewed towards the managing the buying, operating the four-wheelers, and managing the existing three-wheelers, and just adding the three-wheelers to keep that size to that size that we already have. That's how we are looking at the business.
And Vani, just last thing, would you like to say on this same thing that I've asked Maxson, that how you as an OEM look into this E3-wheeler and electric four-wheeler LCV segment in the coming 3 to 5 years? Because even I see that if new portfolio is getting added in the four-wheeler, so definitely from your perspective also, there has been plans into the market that what is the need.
So definitely, I think Rahul, see, the three-wheeler market size itself is limited, right? And the four-wheeler market size is 5x. So the potential which the four-wheeler market size has to grow. So like you mentioned, it's India. Three-wheelers are going to remain, but they're going to remain in the same ratio, be it ICE or be it EV. So the electrification will grow, and yeah, we'll see more of the ICE vehicles being replaced by EV vehicles and more EV vehicles being sold. But I do still see a mix because the use case is very different when it comes to the three-wheeler and the four-wheeler.
Great. And do you see there, like, is there any risk that needs to be addressed in this particular segment, Vani?
So like I mentioned at the start, right, it's a triangle. Uh, and those are the three risks. It's the charging infra, it is the financing, and it is the uptime which the OEM has to provide through service. So whether it's spare parts, whether it is reach, like Max was mentioning. So because uptime is currency for any cargo vehicle.
Yeah.
So all three, if all these three pillars are there, this ecosystem will boom.
Great. I think we have one question from the audience, and this is, I believe, for Maxson, that does Magenta currently offer franchisee operated and company operated model with Euler vehicles?
Yeah. So as a concept, we did try franchisee, but we don't believe we are not operating a franchising model. We have done our business models around franchisee. There are other companies who do that because we like to own our KPI, the SLAs rather, to our customers. But we are working on some other models, which is called the B2B2C, where it is rented out, but not a pure franchisee, because we are a bit more conscious about our brand and how it is deployed and delivered. Not that the franchises can't operate that way, but I don't think we've built Magenta to operate around a franchising model. So I don't see a franchisee, and to be honest, I think we were trying to build the ecosystem, and there was enough uh, firefighting out there on a lot of things where we have not done enough on the deployment models, be it a franchisee or others. We are slowly and steadily doing that. I'm not signing off and saying we will not do franchisee. All that I'm saying is I don't see franchisee happening in this financial year, which is 26, 27 till March 27. Conversations are on. We are doing some modeling, but not yet. So it maybe next year when you ask this question, I may have a different answer, but not this time.
Just one more thing, actually, this is a request from my end. Like, maybe could you explain a bit in short that how this FOCO model works? Because I know that there would be a lot in the audience as well who actually doesn't know about this particular model. So would you like to just give a small explanation on this?
Yeah, sure. So essentially, there are multiple models in the way you operate these vehicles. So one of the models is where I take the risk of buying those vehicles. And when I say buy or owning the vehicles, I own the vehicle either through a loan or a lease, but I become the supposedly the owner, and I take the asset risk. And now I also deploy that asset, but the way I take the drivers on board could be multiple models again. I could say, okay, like the driver is my employee roles or gig worker, and the other way is I can also give out this vehicle on rent, right? Now, classically, this institutions like us, the reason why a COCO model makes a lot of sense is then I can bargain very hard with Vani and say, listen, I'm buying X number of vehicles, and my cost of purchase, that is my playbook, right? That becomes my playbook about how I asset acquisition cost to start with, then the acquisition. So this is the classical COCO model. Now, very interestingly, and this is one thing I don't know if I can state this. The entire logistics industry in India is not a COCO model because 75% or more of the commercial vehicles in India are owned by people, individuals, families who own less than 5 vehicles, which means it's a super fragmented market. Now, sometimes when you buy a vehicle, or let's say you take a vehicle and you say, I want to transport from A to B, between you and the real person who owns that truck or that LCV, I have seen 5 layers, aggregators, truck driver and owner to another, to another, to another. So, which means it's wafer thin divided by wafer also is so small and usko bhi itna divide hota hai. So that's one of the things we wanted to beat. And this is very interesting, and hence the model itself is not COCO, and we thought we'll make a difference, and that's why we went with that. But the traditional model is very distributed. Vani has done enough research on it. I have heard us speak also, so you should ask this question to her as well. Is the way the traditional model is very disparate, with very few people on top managing all of it, right? And trying to optimize. And this is also one of the things I don't think this last point. India's cost of logistics is one of the highest in the world. It's close to 16% of GDP. Why? Because our operational efficiencies layers are so heavy. The global average is close to 10% of GDP. Because GDP is what? GDP is how much good you produce and move, right? So it's a direct reflection. Which means that we have a lot more optimization possible, and COCO is a model, EV is another model. So that's what I see, a lot of opportunity out. Sorry, I went a lot beyond the original question, but I thought this was important.
No, it's always great to listen and have a big explanation from you, Maxson, always. So one last question I'll take from the audience, and this is for you, Vani. And this question, I think, is related to the second life use of the EVs. And I think from an OEM perspective, you will be the right person to answer. Like, how are players currently handling the battery reuse after first life? And with this, I have one follow-up question as well, but maybe I would like to answer this first.
I think it's still early. We've not really gone into this, but having being an OEM, we need to know the future. So, stationary application is where typically automotive use cells would be used. And there are companies in India who look into recycling, so we have tie-ups. Uh, but yeah, I think going through that cycle will teach us a lot, and the system will mature. It's still early for this ecosystem to kind of know exactly what will happen when this comes in.
Okay, and And the last question was actually from my end, and
Yeah.
that is, uh, uh, in this electric three-wheeler segment, I have seen that a lot of imports happening initially to build this particular vehicle. And I have seen that actually Euler Motors have well engineered the vehicle from the electric three-wheelers time, following with the four-wheelers as well. So how do you see the localization from the components point of view in India, right? Uh, from maybe the major components for the EVs, like considering the motors, the batteries. How is the localization overall in the electric three-wheeler and four-wheeler from the B2B fleet point of view? What do you think? How is the status currently?
We've come a long way. This is like the financing question. So, back in the day, there were hardly any suppliers, right? They were mostly ICE suppliers. And if you were to suppose, if I was to put a axle of an ICE vehicle in an EV vehicle, the torque is considerably higher that we would see failures, right? So the whole ecosystem as such has matured. We have suppliers who are able to provide EV grade vehicles, EV grade components, right? Um, the import has considerably, I mean, FAME subsidy also had a 90% Indianization requirement, right? And that's also what pushed all these suppliers to develop because they knew that people would want fame, and for fame, they would have to procure locally. So it made sense for them also to up, upskill, right? So uh, the imports have considerably gone down, I think, but batteries, unfortunately, cells will remain a component which will be under import. But yeah, at Euler, we've done considerable amount of R&D, moving a lot of the embedded part also in-house so that our risk on even the geopolitical situation or um, imports being banned, etc., do not impact our supply chain. So it's been both internal as well as external, working with suppliers, developing it. But I think it's worth the struggle. You don't have to worry about external factors.
So keeping the battery aside, I believe all other EV components, I think it can be localized in India,
Majority
at
of them
least in the
can.
coming 2 to 3 years time, right?
Yes, 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 definitely.
Great. So thank you very much again, Maxson and Vani. It was a really thoughtful and insightful discussion in this webinar. And I also thank all the attendees and audiences who have been present to discuss. Uh, I'll close this particular webinar and thank you again. If there's anything you would like to close.
Thank you so much. Thank you, everyone.
Thank you, and thanks for doing this great work, JMK. Keep it up. We need a
Thank
lot more positive voices in the ecosystem.
Thank you. So I'll be closing this event.
Bye.
you.